What if I told you that 90% of professional investors, people with Harvard degrees, supercomputers, and 80-hour work weeks, fail at their one job? And what if I told you that you could beat almost all of them by doing absolutely nothing? Seriously. The financial industry wants you to believe that building wealth requires staring at 6 monitors, day trading crypto, and guessing which AI stock is going to the moon next. But for the vast majority of us, the single best way to build generational wealth is boring, automatic, and incredibly simple. It's called index fund investing. In this video, we're going to break down exactly how index funds work using the famous S&P 500 as our blueprint. Then, we're going to pit this strategy against individual stock picking and bonds to see who wins the ultimate battle for your money. By the end of this 10 minutes, you'll know exactly where to put your next dollar. Let's start with the basics. Imagine you walk into a giant grocery store and you want to buy some fruit. You could spend hours analyzing every single apple, banana, and orange, trying to pick the perfect ones. That is stock picking. Or you could just buy a prepackaged fruit basket that contains a little bit of everything. If one apple turns out to be rotten, it doesn't ruin your day because you've got 499 other pieces of fruit. That fruit basket is an index fund. An index fund is a basket of stocks that mirrors a specific part of the stock market. Instead of buying shares in just one company, you buy one share of the fund, and your money is instantly spread across hundreds of companies. The most famous index fund in the world tracks the S&P 500. The S&P 500 is an index of the 500 largest, most successful publicly traded companies in the United States. Think of it as the varsity team of the American economy. We're talking Microsoft, Apple, Nvidia, Amazon, and Meta. When you buy an S&P 500 index fund, you aren't gambling on one CEO making good decisions. You are betting on the entire US economy to grow over time. And historically, that's been a very good bet. Over the last century, the S&P 500 has returned an average of about 10% per year before inflation. Now let's talk about the flashier alternative, stock picking. We all have that one friend, let's call him Dave, who claims he made 500% on a random tech stock last month. Dave feels like a genius. But what Dave doesn't tell you is that he also lost 80% on 3 other stocks. Here is why index funds almost always beat stock picking in the long run. First, the math is against you. According to data tracking active versus passive managers, over a 15-year period, nearly 90% of professional fund managers underperform the S&P 500. If the pros can't beat the index, what chance do Dave and his Reddit threads have? Second, you get instant diversification. If you put all your money into one stock and that company goes bankrupt, you lose everything. With an index fund, if one company goes under, it gets kicked out of the top 500 and replaced by a rising star. The system heals itself. Finally, there is time and stress. Stock picking is a part-time job. Index investing takes 5 minutes a month. You set up automatic investing, close the app, and go live your life. But what about the other side of the coin? What about bonds? If individual stocks are high risk, high reward, bonds are the exact opposite. When you buy a bond, you aren't buying a piece of a company. You are loaning money to a corporation or the government, and they promise to pay you back with a fixed amount of interest. Let's look at how they stack up against index funds. Consider the volatility factor. Index funds are made of stocks, meaning they go on a roller coaster ride. During a market crash, your index fund might drop 20% or 30%. Bonds, especially US government bonds, are incredibly stable. They don't crash. However, there is the inflation trap. Because bonds are safe, their returns are low, often around 2% to 5%. If inflation is high, your money in bonds might actually be losing purchasing power over time. The verdict: index funds are for growing your wealth. Bonds are for preserving your wealth. If you are young and have decades ahead of you, index funds are historically the much better vehicle to outrun inflation and grow your net worth. As you get closer to retirement, you start buying more bonds to lock in your safety. Look, I promised you candor, so let's be entirely honest. Index funds are not magical wealth machines without flaws. There are real disadvantages you need to know before you invest. First, you will never have Lamborghini overnight returns. Because you own the average of the top 500 companies, you will never get that 10,000% gain that turns a $1,000 investment into $1 million in a week. Index funds make you rich slowly. Second, you own the bad with the good. When you buy the S&P 500, you are buying the top companies, but some of those companies might be poorly managed, unethical, or in dying industries. You don't get to filter them out. Third, you must stomach the crashes. When the market drops, your index fund drops. There is no manager actively dodging the bullet for you. You have to be strong enough to look at your account, see it down thousands of dollars, and resist the urge to panic sell. So let's tie it all together. Stock picking is thrilling, but statistically, it's a losing game for most. Bonds are incredibly safe, but they won't give you the growth you need to build true wealth early on. Index funds sit in the absolute sweet spot. They give you the growth of the stock market, the safety of massive diversification, and require zero effort. If you want to start, look into low-cost S&P 500 index funds or total stock market funds through any major broker. Set up an automatic monthly contribution. Let compound interest do its thing for 10, 20, or 30 years, and go enjoy your life. If you found this breakdown helpful, do me a favor and hit that like button, subscribe for more no-nonsense financial guides, and drop a comment below. Are you an index investor, or do you still like to pick individual stocks? Thanks for watching, and I'll see you in the next video.